Good morning, everyone, and thank you for joining us for this program on understanding financial statements with the St. Louis Small Business Development Center. My name is Eleanor Chatterton. I'm a librarian at the St. Louis Public Library, and we are so happy to host this today for all of you. We have some upcoming programs with the SBDC through the rest of the year. Next month in May, we'll be doing one on QuickBooks, so that'll be a nice build on this one on financial statements. Then in June, we're going to look at customer discovery with the value proposition canvas, so that should be exciting as well. And without further ado, let me introduce our speaker today. Amina Abdul-Malik is a business counselor with the St. Louis Small Business Development Center, and she specializes in startup services and business plan development. And I will turn it over to her to talk more about the SBDC, introduce herself, and move on with the program.
Thank you so much, as always, Eleanor. I know you probably get tired of hearing me pump up your program every month and tout you all as my excellent partners. But I really do believe that the public library and their system is one of the best no-cost and low-cost resources for entrepreneurs and small business owners like yourselves because of the amount of access they have to important market research and data, and the librarians like Eleanor and her team and others there who are able to provide assistance with some of the tools that they have. So I love the public library system, and I'm very, very happy to be able to provide these training programs for them as well. But as she just stated, my name is Amina Abdul-Malik, and I'm one of the counselors with the St. Louis Small Business Development Center. And feel free to raise your hand, or feel free to come off of mute, or even type in the chat. How many of you all have heard of the Small Business Development Centers before already? And I apologize, this allergy season is now, I thought it wasn't getting the best of me, but now this week it is starting to. So I apologize if you hear any sniffles or any coughs or anything like that. Okay, well, for those of you who have not heard of us, the Small Business Development Centers are really a nationwide network of support for entrepreneurs like yourselves who are looking to either start or grow your existing small business. We assist in two major areas. We assist through one-on-one counseling, as well as training and technical assistance programs like this one today. And we like to think of ourselves as expert generalists. So we're not experts in all of your different industries. I always tell my clients that you all have the real life wisdom and knowledge, and I just have the business structure and business skills that we blend together for success. But we do assist with things like business planning, registration, getting you access to capital or getting you bank ready, also helping you prepare a strategic or growth plan, helping you prepare financial projections or better understand your current financial statements. We also work with a lot of the other support organizations that are here locally and as well as nationwide. So that's just a little bit about our organization. License registration and STL, that's definitely something we assist and talk to our clients about and provide guidance and recommendations on. When it comes to licensing in St. Louis City, it's really going to typically be something called the graduated business license. But yes, if I'm pronouncing your name correctly, Israel, that would be something we could talk about in a one-on-one counseling session as well, the various licensing that you would need for the city of St. Louis. Eleanor has already kind of provided a little bit of my background, but I did start off in sales and retail and got 2 degrees in business and finance. So I live and breathe small business and entrepreneurship. So it would be my pleasure to help you all and assist with your business development. And I know that my contact information will be shared with you all so that I can make sure that I get you all a copy of the slides. And then there are some additional spreadsheets and next steps that can be taken from this presentation to actually take it back into your business. As I'm going through these objectives today, I usually would give us a bunch of time for introductions, but specifically with this financial presentation, I've already kind of hidden some of the slides that are more in-depth so that we'll hopefully be able to get through all of this information because there is a bunch of content in this presentation today that I'm going to be trying to get through. So while I'm going through the class objectives and we're getting started, I would love for everyone, if you feel comfortable, to put an introduction into the chat for us. with just maybe your name, what type of business or what stage your business is in. And then also let me know how comfortable you feel like you are with understanding your financial statements and really just the overall financial management for your company. And as we're going through the presentation, I'm going to read off some of these introductions as well. So getting into the objectives for today, and these are the topics that we're going to learn about and discuss. The first one is going to be what we're going to learn about the different key information that is obtainable from your various financial statements. So there are three major financial statements that you will read about with your for your company, and that is the profit and loss statement or the income statement, the balance sheet, and the cash flow statement. Today's presentation is really going to focus more on the profit and loss and balance sheet, but the cash flow statement is another one of those major financial statements, and that's something that I would also recommend getting some knowledge and information about as well. But today we're going to learn about all of the key information and things you can learn from glancing at and just taking a basic look at your profit and loss and balance sheet. We are also going to learn about the key financial ratios, what a financial ratio is, first of all, and how we can calculate and use those key financial ratios to help your business make better decisions on a day-to-day basis. And let's look at some of these introductions coming in. Carrie, it's nice to meet you, Carrie. Carrie, my name is Carrie Russell, and my business is called DBG Creative, which is an interior design company. Amazing, amazing. Thank you so much for joining us. Brittany, and if I'm not pronouncing these names correctly, feel free to come off of mute and correct me. I'm totally informal in that way. So Brittany Raja Alberti, you are an attraction marketing strategist. Ooh, we love marketing around here, obviously. And when you combine marketing with good financials, you almost can't lose. So thank you so much for joining us, Brittany. Jessica, nice to meet you, Jessica. Thank you for coming. Jessica here, co-founders of Sophia Rising, a collaborative spiritual organization reclaiming the feminine divine within Christianity. You are in the process of incorporating as an LLC, but structuring as a co-op organization. I'd love to talk to you more about your legal structure and the options that you have surrounding that as well, Jessica, and thank you so much for joining. Israel, go ahead. Did you have a question? Or want to introduce yourself? Go ahead.
Yeah. My name is Israel. I actually started my LLC last year. I uplift and empower women and girls to live more authentically. I do have the LLC. I am aware of financial jargon and information, but not the application thereof. So I'm excited to hear it today.
Gotcha. Thank you so much for joining. And Barfield, or Chrissy, excuse me. And if I'm mispronouncing your last name, I apologize. But hello, Chrissy from MCCB Transitions, Inc. And you are in the Ville neighborhood and looking for capital funding to help unhoused individuals. And on a scale of 1 to 10 of understanding financial statements, you feel like you're about a 5. And that's good. Coming in at about a 5, you know, a lot of times, and even before I started getting into business development, even if you're familiar with looking at financial statements, just like Israel just stated, you can understand some of the jargon and language in that, and even understand a little bit of what you're reading, but then taking it into practice and understanding how to analyze those statements is the next step as well. So thank you so much for these introductions, and feel free to continue to type in the chat as we continue to go through the presentation today. And we are going to jump in part 1, which starts with us taking a look at those 2 key financial statements that we're going to be focusing on today, which are the profit and loss statement and the balance sheet. So when you're thinking about your small business, there's a landscape that your business exists on, or an environment that your business is operating in. And within that environment, and from your business doing its day-to-day activities, you come up with the sources of your financial information. And the first source or the first place that financial information that your company or those financial activities that your company are participating in sits in is that chart of accounts. And simply put, a chart of accounts is really just the area or the place where your business defines those different types of financial transactions that occur within the business's life cycle. So the chart of accounts just provides your business those various definitions of those different types of transactions that are going to occur. The chart of accounts provides you the different types of accounts that are going to then go into your general ledger. And the general ledger is a summary of all of those different transactions, which are grouped by the type of account that transaction occurs in. So for instance, here we have some examples of types of accounts, and some types of accounts include sales or your revenue. And then when you go into more detail in your general ledger, your sales will be also organized and broken down, and there will be different types of sales accounts. There may be a retail sales account or a commercial sales account. You have your utilities that are organized into a group, salaries. And so all of your different types of transaction are organized into groups. And then those groups are then listed on your general ledger. From your general ledger, once you have a summary of all of those transactions that have been made within your business's life cycle, you then can go ahead and create the various statements that we're going to learn about today, as well as key financial ratios that we're also going to talk about. And so that's kind of the breakdown of how your information starts off from just being a transaction to being organized into these different components or places. So we know that the general ledger is organizing all of those different transactions and creating these different statements, but then we can take a little bit of a deeper look at the financial management cycle and see that we, as you all know as entrepreneurs, are always constantly multitasking through these various areas of your financial management cycle. So let's say if you are in the startup phase for your business, or even if you are not and you've been operating your company, you are always going to be predicting future performance. And there are several ways to predict future performance within your company. And we mentioned the cash budget and something called Pro Forma Statements here. Has anyone already heard, and feel free just to come off of mute or type in the chat, has anyone heard of the term already, Pro Forma Statements, and can give me kind of their definition of what it is? If not, what a pro forma statement really is just another word for financial projection. So whenever you see the term pro forma statement, it really just means it is a projection for your financials. So those two terms are used interchangeably when you're thinking about small business financials. So you may hear pro forma statements used, which is essentially the same term as a financial projection. So don't let yourself get confused if you see that pro forma term. But pro forma statements or financial projections or financial forecasting, as well as doing budgeting, it will be two of the best ways that you can easily start to try to consistently predict your future performance. And then at the same token, the next component of that, you are also going to be documenting past performance while you were in business. And that involves you analyzing, or excuse me, having, first of all, a profit and loss statement and balance sheet. And then finally, you're also going to use that documentation of past performance with those financial statements to then go ahead and analyze your past performance. So what can you garner from those different financial statements? You can have a better analysis of your cash flow statement. You can create financial ratios and do countless other analysis by documenting your past performance, which leads you back into the front end of the financial management cycle, where you are then reviewing your past performance, analyzing it, and then coming up and predicting for future performance again. So it's always going to be a little bit of multitasking between all three of these areas when you're in business, and having a clear understanding of the financial management cycle can better prepare you for taking some of these steps. So the two statements that we're going to be focused on today, I definitely have a favorite of mine, but both of these statements are equally important in terms of the health of your business. And those are going to be the profit and loss statement and the balance sheet. So the profit and loss statement, a few things to note before we dive into one and take an actual look. A profit and loss statement, and there's two different terms that you can use to describe a profit and loss statement. You all may have heard the term income statement before, or you may have also heard the term profit and loss. Another one of those interchangeable business terms, doesn't matter which one you use. I tend to use profit and loss when I'm explaining the statement because it makes a little bit more sense for the mind to understand versus just describing it as an income statement. But there is a reason why that it's also called an income statement, and we'll discuss that when we take an actual look at one. But what you are seeing with that profit and loss statement is always going to be a summary of the revenue or sales of a company or what you made, and also a summary of what you have spent over a period of time. So your profit and loss statement is showing you what your company has made in terms of revenue or sales and what your company has spent over a period of time. That all in all, once you add up everything the company has made and add up everything the company has spent in terms of revenue and expenses, you end up with a profit or loss, which hopefully if you are profiting, you end up with net income. But we'll talk about that here when we take a look at the actual statement here in just a second. The balance sheet is a statement that is always going to show you what your company owns or assets, what your company owes or liabilities, and also your net worth. And so when you calculate all of those things with what your company owns and owes, that essentially will give you an idea of your company's value or net worth at a particular moment in time. So that's one of the key differences between your analysis of your profit and loss statement and your balance sheet is that your profit and loss, you're going to be analyzing that over a period of time versus the balance sheet is giving you a snapshot of information for your company at that moment in time. But both are documenting past performance of the company. And yes, I also like that side by side, Chrissy, because it makes it a lot easier just to understand the key differences. So now we are actually looking at a sample profit and loss statement for a company called Computer Solutions. And we just want to note just a few things about this profit and loss statement. At the top here, and let's see if I can get my laser pointer here. At the top, you will always start off an income statement with a description here of the company's revenue or sales. I like the term revenue because sales is usually a term that is specific to for certain types of businesses, indicates retail, it indicates certain types of revenue. Revenue is kind of more of that blanket term, but you can use revenue and sales pretty interchangeably, and we will know what you mean. As you can see, this example actually uses sales. So they have their net sales here, which equal out to around $628,000. Usually, when you are looking at a more detailed, your income statement, or excuse me, profit and loss statement, your revenue will be organized also in terms of the streams of revenue. So yes, you will have your income section, your net sales, but those net sales can usually be broken down so you can even understand the portion of revenue that is coming from each different revenue stream. So that's something your income statement will also have included on it. So once you've identified all of your sales or different ways that your company has made money for, typically an income statement is made for a calendar year, then you have your total net sales line, or excuse me, total income as well. The next component of any income statement is going to be understanding the cost of goods sold. I don't think I see anyone in the chat or that introduced themselves that is a more product-based company. But if you are selling an actual tangible good, your cost of goods sold are all of those costs that are directly associated with you. Okay, great, Jessica. Those cost of goods sold are going to be all of those costs directly associated with you producing or selling that product. So that includes the supplies that it takes to make it, the manufacturing cost. And I'll definitely explain why that does not go into expenses here. Okay, and Israel, you're selling digital products. I thought I may have missed that, and I heard who you were selling to and why, and I missed exactly what the what was. So, okay, great. So cost of goods sold is everything that goes directly into the production of that product that is not related to, that's directly related to the production of it. The reason why, and that gets you that gross profit line here. I like to think of gross and net. I like to think of gross as just everything. It's gross. It's a gross representation of what we're looking at. So it's a broad scope. And then I like to think of net, when I always forget the difference here. I always like to think of net as what is captured in that net after all of those extra things like taxes and interest are drawn out of that net. Your net is that revenue or those costs that are still left in that net, that bag that you're still holding. So that's kind of how I always remember gross versus net. But your gross profit is that your revenue after you have paid for all of the costs associated with actually making that product. Then you're able to go down here and calculate your expenses. Now, the reason why your cost of goods sold are separate from your expenses is because your expenses are those reoccurring costs that are not directly related to the amount of something that you're selling. So, Jessica, if you sell, your cost of goods sold is always going to be directly related to the amount of net sales that you have, because your cost of goods sold is obviously going to increase as the amount of sales or the amount of something that you have to produce increases. Expenses, on the other hand, will not always increase at that same rate. They may, but they may not, because they aren't directly related to the production of that product. Your expenses are things that are reoccurring costs, but ones that are not directly, that aren't related to how much of your product you're going to sell. And that's why they're separated, and you want to understand your cost of goods sold and your expenses because of that. And yeah, so you can see the expenses as kind of as somewhat like your overhead costs, because those are extras that aren't related to you directly having to pay for those in order to produce the product, but they are overhead costs because they are still a component of you operating the day-to-day of the business. And so that's exactly why they're separated. So thank you for that, Jessica and Israel. And different businesses are obviously going to use different expense categories. Of course, if you're working with the SBDC counselor in our team, I actually walk you through creating business plans that include financial projections or creating financial projections for your existing business. And there's a methodology to try to understand and come up with projections for some of these things. But the main thing I want you all to note is your expenses are going to be different based on your businesses. But so you might not use every category, but it's very, very important to accurately estimate your expenses, because what you get here at the end is that total expense number for the calendar year, but usually we start off on a month-to-month basis to get here. And then you are left with your net ordinary income. Now, we would think, or we would love if that was the final number and that was just our overall net income, but we still have to remember those other things, those pesky fees and costs that come with, interest expense. And also, we didn't include taxes in this income statement. But after you have calculated the interest that your business is paying, and your business could be paying interest on many things. That could be on a bank loan. That could be on a piece of equipment that you purchased that is a long-term piece of equipment that is depreciating over time or slowly losing value. You could have interest on a supplier contract that you have. If there is any interest that your company is paying, that interest expense will go in this bottom section of your income statement. And after all of that is taken care of, you are left with hopefully your net income number, which should indicate a profit for your company. So that is why the profit and loss statement is also known as the income statement, because the final line item and the ultimate thing that your profit and loss statement is indicating for your business is the net income or net loss. But let's hope it would be a positive net income here. And we can see that Computer Solutions has a net income for this year of $15,703. And if we just go back, a couple things to note in this example here. Their net sales were around $628,000, and their cost of goods sold was $364,000. One thing I will say for all of you all that are product-based companies, and I'm spending a lot of time on this slide, but please, please, please heavily monitor your cost of goods sold. This is where the library, Eleanor and her team can also come into play. Yes, that is a very, very gross difference from 628, which indicates that their cost of goods sold percentage, and when we're talking about cost of goods sold, we're really going to be looking at percentages for these, because we want your cost of goods sold percentage, if you are a product-based company, to be as low as possible. Now, what is low? What is high? You really don't know that until you are able to benchmark your financials against other similar solutions or others that are specifically in your industry. And that's where Eleanor and the library team can also be of assistance. They have access to a bunch of market research, and I believe they even can pull some information about benchmarks in the industry, other financial ratios from the industry, so that you can understand what is a good cost of goods sold. Maybe for this type of computer solutions company or for this type of solution, 50% cost of goods sold is normal. But regardless of that, I can see that and say that that's something just as an advisor that jumps out to me, and that you all should be consistently trying to monitor and lower is your cost of goods sold percentage. And we'll look again at this in just a few slides here. We talked about some of these key terms within the statement already, how net sales minus gross cost of goods sold will get you your gross profit, and then how the cost of goods sold is really the cost of you actually purchasing or producing those goods that are sold during that specific period of that statement. We also talked a little bit about the expenses so far. We see that the main expense categories for a computer solution that they are spending very high on, or the officer salaries. They're spending pretty high on wages, or they're spending on wages, which is no problem with that. You have to spend money to make money, but they're also spending on depreciation expense. We'll talk about that here and learn about depreciation, but those are some of their major expense categories for this company. You have your interest expense, and then your final net income or net profit number. And that is just your amount remaining after you deduct all of those standard costs from doing business. This is why the profit and loss statement is probably my favorite statement to start off working with clients on, because it's a great indication of how the operations of your company are going. And it also is helpful for me to understand the potential cash flow of a company as well. Any questions so far about the profit and loss statement before we learn a little bit about the balance sheet? Okay, great. So now taking a look at the balance sheet. As we learned about before, the balance sheet is an indicator of what your company owns and what your company owes at a specific moment in time within your company's life cycle. And we're going to kind of dive into the different components here now of the balance sheet. And Carrie has a question here before we do that. If you are self-employed, would you consider what we pay ourselves in the salary category? There are a few different ways that you can pay yourself, and it depends on how your business is registered, number one. If you are an LLC, which is probably the best practice here in the state of Missouri for small business ownership, great. You're a sole member LLC. Love it, Carrie. The best way usually the best practice for you to pay yourself is to use something called an owner's draw, and to not indicate that salary that you're going to pay yourself in the salary category of in the payroll category of an income statement. So the best way to pay yourself is to take an owner's draw in most cases, versus actually paying yourself in the payroll category. And to indicate that on your income statement, you can indicate that there's several ways that you can indicate you paying yourself on the income statement. And so that doesn't matter where you put that as much at all. You could make an owner salary expense line and put your salary there. But as long as you're indicating that you're paying yourself somewhere on the income statement as an expense, it's fine. The more important placement of where you're paying yourself actually is going to be what we talk about here on the balance sheet, which is where you're indicating it as an owner's draw here. So we'll talk about that in just actually a few minutes here. But the best way to pay yourself is through an owner's draw, not through paying yourself. Usually it's not through paying yourself on payroll. Now, there are some benefits to you paying yourself as an employee for tax purposes, but that's something that I always say also to potentially speak with an accountant about, because the traditional way that we are told is to pay yourself through an owner's draw. And the benefits of you paying yourself through an employee, I believe, are related to growing the business in terms of its potential standing with the IRS. But traditionally, we say to pay as an owner's draw. But I'll talk about that when we get to this section of the balance sheet here in just a second. And Jessica, those terms are pretty interchangeable to my knowledge. Disbursements or distributions, I think those terms are pretty interchangeable and one of those terms that you can pick. But we can look into that a little bit more. But I believe, seen both terms used when it comes to partnerships. And that may go into, how is your business registered, Jessica? Is it registered as some type of corporation or just an LLC? Okay, yes. Then I think interchangeable is fine with those two terms. So looking at a balance sheet, and we're starting off with the first component of it, which is everything that your company owns, or those assets. And your assets, or the things that your business owns, are always going to be organized in terms of liquidity. Is anyone familiar or has heard of the term liquidity when it comes to business? And what liquidity means liquidity is how quick and easily and efficiently an asset is able to be converted to cash. So when we're looking at the assets on Computer Solutions balance sheet, the most liquid asset that they have is cash. Cash is the most liquid. Then as we go through their other assets that are still organized in order of liquidity, they have their accounts receivable. Then that, if they had any inventory, that would also be in the current assets section. Or excuse me, the current asset section, and then inventory is included after those current assets, which include accounts receivable and any inventory that you planned on using within the next 30 days. All in all, your assets are going to be organized in order of how quickly you can convert them over to cash. Then after you get out of those current assets and you look at the fixed assets, those are some of those more long-term assets that do usually depreciate or lose value over time, like a piece of property, a vehicle, or a piece of equipment or machinery. And so we can see that those fixed assets are still organized in order of liquidity. and you have something called accumulated depreciation that sits as a asset line as well. I don't want us to take too much time on depreciation, but it is still a very, very important term to know. What I will say about depreciation is you can see that depreciation is a contra asset, or it's in the asset category, but it's always going to be a negative number, but it's in the asset category. The reason why that is because they still want to indicate because it's still related to the value of those assets. And so they call it a contra asset. And so it will still be in the assets category, but it will be a negative number that indicates how much all of your fixed assets have depreciated over their use life, or the life that they've had. All in all, your assets will be totaled up here. So you'll have the sum of your total assets, which for Computer Solutions is around $233,000. And so Computer Solution owns $233 worth of assets for its company. Then the liability section is going to show you everything that your company actually owes. So your assets were organized in order of liquidity. So are your liabilities. So your current liabilities include those things that you are going to be paying in the next 30 days, in the next 6 months. And so those include things like your accounts payable, which I'm going to talk a little bit more about in just a second, as well as any other current debt that you are going to be paying on in the near future. You also have your long-term liabilities. One of the major long-term liabilities that can exist for your small business is going to be your bank loan. And that bank loan, as there's two different areas where your bank loan is going to sit within your balance sheet. The first is that notes payable section. And the notes payable and current portion of long-term debt is where those short-term loan payments are going to go. So that current portion of long-term debt is what you're planning to pay in the next year. And then the bank loan payable section is the remaining balance of that bank loan that is not expected to be paid within the next calendar year. And so the main thing to note with the liabilities is that your debt is housed here. And so if you're trying to analyze your company's financial structure, you can easily look down to the liability section to get an idea of everything that you have going on that your business owes at that current moment. Equity is the final component of a balance sheet. And equity describes the owner's claim against the company's assets, or you can also see the equity section as what the owner has put in and also is taking out, what the owner is taking in and out of the company also. So in the equity section, you have the owner's draws. When we were just talking, Carrie, about the best ways to pay yourself if you're self-employed in the single member LLC, you would be looking at the owner draw section. And so you would put a draw in and take a draw out. So if you said, oh, I'm going to pay myself $5,000 this month, then that would be an owner's draw, which would be a negative number in your equity section because you're taking that money out. The other components within this equity section include paid-in capital. Paid-in capital is the money that you have injected into your company or put into the business. So that's the money that's paid in. And then you have retained earnings. Retained earnings is a very interesting line. And I want you all to be aware of this line in your future analysis with your company statements, because retained earnings is the place where money that you have made, that's net income, but you haven't put it back into another asset or liability, will go. So retained earnings is all of that money that is retained from the profits of the company that has not been moved back into another asset. And then finally, the net income, which is those profits that the company has received as well. So the net income and retained earnings line are different because retained earnings is sitting there with the impression that it's going to go back into another asset. the net income could be pulled out as an owner's draw and hasn't been necessarily structured yet. So the net income is just the money, the profits right there that are sitting there. The retained earnings are supposed to be going back into the business. And Israel, I see you have a question here. Are the latter two technically negative then? They are not. And that's a great question. And the reason why they're not negative is because until they are reinvested or taken out as an owner's draw, those two lines are still going to be positive for the company because it's still money that the company has and owns, but it hasn't been reinvested into the business as an asset. So right now it's just in the equity account. It's in the equity section. And so that's why it's positive, because it's still a part of equity, but it just hasn't been moved into another asset line, or excuse me, another liability, going into a bank loan or purchasing another piece of equipment. And so it's still going to be, those two are still going to be positive. And then how often would you run a balance sheet? That's a great question. I would run a balance sheet probably every month or so. And that will just get you in the habit of reading your statements. Number one, there may not be any changes that you see on a month-to-month basis, but that will get you in the habit of reading a statement. And then what you also do, and more important than just reading a statement, as we can see, is going to be comparing that statement to a previous month. So if you're not running them every month, I would at least do quarterly and start to give yourself a month by month, start to try to do month by month comparisons every quarter. And then if you're using something like QuickBooks, which you can get for about $12 a month if you're a single member LLC, just to keep track of revenue and expenses, it'll automatically have these statements generated for you at any time. So when you log into your QuickBooks account, you can see your current balance sheet for any period, and run an income statement for any period. So you always have access to this information. And please keep the questions coming, you all, as well. Thank you so much. Oh, losing battery on my AirPods here, so let me just make sure I am prepared there. Okay, and then a couple other things I wanted to note here on the balance sheet. We know that the assets are everything that the company owns. We know that the liabilities are everything that your company owes, and the equity is what's left. So that's kind of the equation for your balance sheet. But one thing I want you all to always note when you are creating your first balance sheet, or not your first, but if you are creating a balance sheet or reviewing or analyzing your own or others, one thing you'll note about every balance sheet that is done correctly is that the assets will always equal the total liabilities and equity. In this case, Computer Solutions has $233,000 worth of assets and the same amount of liabilities and equity. Can anyone tell me why that might be? And when you think about the reason, you know, they used to ask me this all the time, and I'm like, I don't get it. What do they mean? And when you think about the reason why these numbers are equal, yes, Carrie, very, very true. That's exactly why. Why is it that your total assets are always going to equal your total liabilities and equity? The reason why these numbers are always going to be equal, and so if you run a balance sheet and these numbers are not equal, something's off. And that is because, as Carrie just stated, everything must be accounted for. And so every asset that your company owns was either paid for through debt, which is a liability, and there is good debt and bad debt. The good debt is the debt that is paid back from the revenue of your company at a favorable interest rate in terms. That's good debt, because your business is usually going to be funded through debt and equity. So all the assets and everything that your company owns was paid for either through a liability, which is debt, or some type of equity, which is the money that you have put in. And so simply that is the main reason why these two numbers are always going to equal, because everything that your company owns was purchased either through something you owe or some equity that you contributed into the business. And in terms of that also, you bring up another great question also about the balance sheet, Israel. It's the bank uses the balance sheet as an indicator of valuation. So it is also a great indicator of the bank for a lender of any kind to understand how liquid a company is, because you can easily see how leveraged the company is into their fixed assets and their long-term liabilities. So you're completely right that this statement helps lenders and yourself understand the amount of assets that could be liquidated if something then went wrong with the business. Any questions about the basics of those two statements before we dive into some really quick information about the two different types of accounting systems? Okay, so part two, just want to give some quick information about the two major types of accounting systems, which are the cash accounting system and the accrual accounting system. I'm not going to spend too much time on this because usually the accrual accounting system is going to be best practice for small businesses, and it's kind of somewhat the standard, but it's not going to be a deal breaker for your companies in terms of choosing accounting systems. But I do want you all to know the differences between the two. The cash accounting system is a simple accounting system. It records the value of each transaction your business has when cash or the funds are actually flowing in and out of the business, okay? Accrual accounting accounts for more variances in a transaction because it records the value of the transaction at the time that the transaction occurs, but not necessarily when the cash is being handed back and forth. So with accrual accounting, with cash accounting, it really operates as if everything is a perfect world. So you get supplies, you pay for supplies right at that same moment. You sell an item, you get paid for that item, all in the same time frame. Now, that is the perfect world, right? But we know how often, especially even when you're selling products, but especially if you're a consulting-based company, when you invoice a client and you give them net 30 days to pay, and it's 35 days, it's 40 days, sometimes in a perfect world, you're not able to buy and sell things all in the exact same time frame. So what do you do when that occurs? You're able to lean on the accrual accounting system. And within the accrual accounting system, you're able to account for those times where you get supplies and then pay for them down the line, and the time that passes between each different part of your transactional process or transactional process. And with accrual accounting, it basically means that revenue and expenses are going to be recognized and recorded when they occur. And with cash accounting, these line items aren't documented at all until the cash actually exchanges hands. So cash accounting is easier, but accrual accounting portrays a much more accurate representation and portrait of your company's health, because it includes those times where you're either waiting to receive funds, which is your accounts receivable, or where you're waiting to get paid, where you're waiting to pay funds, which is your accounts payable. And those were two different lines that were on your balance sheet here. So essentially, accrual accounting is usually going to be the best practice and what is going to be recommended when you are using any type of accounting system. But the cash accounting system is still available for those very, very basic businesses who just want to, who are always receiving payment immediately and not doing any type of billing or not doing any type of paying later on any of their goods or services. Any questions about cash accounting or accrual accounting before we dive into the last two components of this presentation, which go into a case study for computer solutions, and we're going to kind of dive a little bit deeper into how we can use some of this information and the things we can garner from taking a deeper look at these various statements. We know that the profit and loss statement tells us how your business is doing. You can see on the base level, the net income for a company. You can see how much is spending on producing the product, how much is spending on keeping the business going on a day-to-day basis with those expenses. And it ultimately is an indicator of profit for your company. The income statement is used to make decisions on things like pricing strategy. If your cost of goods sold are it's a very, very high percentage, it helps you and you're able to look at your revenue. You're able to start thinking about potential ways to price your product or service a little bit better. You're also going to start thinking about things like margin maintenance. And when we talk about margin, that can mean a lot of different things. That can mean your margin between your revenue and your expenses. And so you'll be able to take this information and start to evaluate if you are potentially overspending in any of these expense categories. And that also is a part of what you can garner from your income statement, is analyzing your expenses to determine if you are spending on your expenses efficiently, or if there are opportunities for you to decrease the amount of expenses that you are paying. This is a profit and loss year-over-year comparison statement, and it has 4 years of comparison. Now, when you look at this, I'll be honest with you, even with my corrected vision, my 4 eyes, the years that I look at financials, every time I see a financial statement, it can look like a wall of numbers, no matter how much I know about these statements. So we are going to talk about on the next slide one of the easiest ways for you to organize these financial statements to be able to more easily analyze them. But before we do, what we're looking at here is just year-to-year comparison, and we can see that they started off, and let's say this is 2001. They started off with a gross profit of $185,000, and year over year, they have been successfully increasing their gross profit. In the same token, their total expenses have increased. So that sounds somewhat natural. They're spending more money keeping the business afloat or open, and they're also increasing their cost of goods sold. So everything's increasing. The profits increasing, the expenses are increasing, and the cost of goods sold. We also can see that by how much their expenses have increased by. Ultimately, I would jump right down here and look at the net income line and also see that all in all, with all of these things increasing at the various rates that we don't really know yet, because I'm not calculating all these numbers, who wants to add all this up and see what the differences year to year are? We don't have time for that. We're entrepreneurs. We're wearing so many different hats. Ultimately, by looking at this statement, I can see that the net income also increased year over year. When this company first started back in 2001, they actually had a negative net income of $9,000, which is sometimes natural for small businesses. You may not profit until year 3, but year 2, they were able to bounce back, profit $5,000. Then now that third year, they only profited $2,008, and then they jumped up to profiting $15,000 or having $15,000 of net income, at the end of year 4. So these are just a few things we can note just by looking at this grandiose or growth statement, I'll call it, before we add any tools to make it more easier to read. Jessica, you asked, yes, QuickBooks will definitely generate these kind of reports very, very easily. And what they do is there's several different ways you can have QuickBooks generate reports. One of those is, and we actually will be having our QuickBooks class as well next month. So please make sure you sign up for that, because we'll be going over a lot of this information in more detail. But within QuickBooks, you are able to take pictures of your receipts, or the easiest way to do it is if you have a business checking or savings account set up, you can sync it with your QuickBooks account. And so all of the transactions will automatically be accounted for in your QuickBooks account. And so it'll automatically create your profit and loss statement, your cash flow statement, your balance sheet for you using that bank account information, and it'll always be up to date. So you don't ever have to generate, well, you can generate these reports whenever you like in QuickBooks, but the information that you need to generate those financial statements will always be there. So you just have to click Run Report. Common size statements, yes, works very similar to Mint. Mint is another popular tool as well. I'm just a little bit less familiar with Mint, but yes, same tools, same principles there. So how can we make these financial statements a little bit easier for us to read? One of those tools is going to be a common size statement. And a common size statement, what it does is it converts each of those different accounts, which are those different line items, to a percentage. You can also use the term percentage size statements when we're thinking about these common sizes. And common size statements are always going to be used to compare, or can be used to compare, your current financial performance with previous periods. You can also use common size statements to compare your financial performance with similar size companies in the same industry as well. So let's take a look at the same profit and loss year-to-year comparison with these common size statements included. And Chrissy, you bring up a very, very good point with QuickBooks. It will run the reports very, very easily with you just inputting or syncing your bank account information. But you say that your understanding is that you must put transactions in the correct chart of accounts for correct info into QuickBooks. That's very, very true. So on a base level, QuickBooks will run those reports, but you will definitely want to go through that report to make sure that every different transaction type is put into the correct chart of account. So I'm glad that you brought that up, Chrissy, and that brings up what we started off the presentation talking about, is that chart of accounts. But overall, QuickBooks will do a good job of creating financial reports for you. You will just need to make sure that things are organized in QuickBooks correctly in terms of your different revenue and expenses categories. And then from there, it will run accurate reports for you. But yes, great call. So when we add in these common size statements and these percentages here to these different accounts within this year-to-year comparison, we can see a little bit more because the common size statements are putting everything against as a percentage of your total income for your business. So now we can see, if we look at these expenses here and we're looking at the total expenses, that total expenses are down about 8% over this 4-year period. And so when we looked at this number initially with just the numbers, we see a steady increase. And so if we didn't have these common size statements here, we would maybe just indicate without any further analysis that, oh, expenses are increasing. But when we add in those common size statements and we see that the actual percentage of income that these expenses are accounting for is actually lower and lower, we can actually see that total expenses are down 8% over this 4-year period. So they have been able to make more money while still reducing the amount of expenses that it is costing them while the amount of expenses they are paying for while they are facilitating that revenue. Another thing that we can indicate here by using these common size statements is if we look down at the net income number. This is also a very interesting indication here. And when we look down at net income, let me move this over here, we're able to see that net income, it started off as a negative 2% down here. And that's when the company was first starting. It then goes up to 1%, and then after that 4 years, and at the end of that 4th year, we can see that net income overall has increased by 4% and come out of the negative in this 4-year period. And so it indicates the consistent growth and health of the company. And so these common size statements are ways for you to easily or more easily be able to make comparisons and understand the statements that you're reading. The last thing I'll note is, if we go back up to cost of goods sold, we can see just about how much that number has increased. And this is something for computer solutions that I think is providing them a little bit of risk, and it's something that can maybe be something that they can take some further analysis into. Is their cost of goods sold it starts off at 53, it jumps to 55, 57, 58. It's steadily increasing while they are increasing revenue. Now, the cost of goods sold, you're obviously going to spend more money on producing more products, but the percentages of income should still be able to maybe stay around the same number. We still shouldn't necessarily see it jumping up to almost 60%, because that means that, yes, you're spending more, but it's still taking up more percentage of that income as well. So that can be a sign of a potential challenge for this company as well, and something to think about. But these are just some examples of things that you can garner through using common size statements. I won't take too much extra time on the balance sheet because we've already learned about what the balance sheet is doing. We talked a little bit about liquidity again, and we know that liquidity for a small business means the ability to cover short-term financial obligations and the ease that that company will be able to convert those assets to cash. And the balance sheet is a great indication of the book value or the overall value of your company. But understand that because it is just for a moment in time, that it's not necessarily going to be the best reflection of actual value. And this is something that the banks will definitely look at to determine your company's liquidity and its indebtedness and how leveraged your company is to debt. We already know that about this equation for your balance sheet as well, which is that your assets are always going to equal your liabilities and your equity. Everything that your company owns was purchased through debt or something or equity. I won't take too much time on this because I want to make sure we have a little bit of time before 11:30 to get into the financial ratios. There are a few different resources that the Small Business Development Center has for you to get more information and help with understanding your financial statements or coming up with financial benchmarks, finding financial information for your industry. So if that's something that you are interested in, we can definitely discuss those financials and those resources that we have as well. But we're going to wrap up today by learning about some of the key financial ratios that can be used from your financial statements to understand your financial performance. And so now this is one of the components of that analysis step, and we've documented the past performance already. And so the financial ratios are one of those analysis tools that we use. And Jessica says, we regularly produce events, retreats, workshops. Would expenses related to events, i.e. food and supplies, go with the cost of goods sold? Yes, that would definitely go with the cost of goods sold only. Well, let me say it depends, Jessica. That would go with cost of goods sold if it is only purchased on an event by event basis. If you purchase those things in advance with the goal or the hope that you're going to facilitate so-and-so number of workshops, then that's an expense. So it depends on how you're purchasing it. But if you only if you're waiting to purchase it at the time of each event and you say, here's an event, then this things will be purchased for that event, then that will go, that could go as a cost of goods sold. And I can quickly re-show that resource slide as well, but I also will be sending Chrissy a copy of the slides out to everyone as well. But yes, there's ProfitSense, BizMiner, your local SBDC. Really taking note of those first two is going to be the most important. And then also the library and Eleanor's team also have access to a lot of financial ratio information as well. So let's get to the ratios. A quick note about the operating cycle. We know that we're constantly multitasking through the financial management cycle, But also understand that when you have sales from your company, okay, that the sales provide you net income for your company. And then those profits go back to paying off or paying for a new asset, paying off a liability, or paying distributions. And you see that distribution terms is here. I think, Chrissy, you asked about that, or Jessica, and those terms can be used interchangeably with disbursements. Either way is fine. When you pay for and use those profits and put them back into the business, your assets are always going to go up. Your liabilities are going to go down because you're paying off debt, and your net worth is actually going to go down as well because you're putting that money back into the business. Ratio analysis. Financial ratios are a very, very popular way to try to analyze previous performance or compare your performance to other periods or to other businesses in your industry, because they are simple equations that you can pull using information from your basic financial statement. This is an example here of how you set up a typical ratio. And for this example, we will use liabilities and equity. And the liabilities of this company totaled $100,000. The equity totaled $20,000. Divide that, and you have your ratio here. So essentially, for every $5 of liability that this company has, they have $1 of equity. Now, let's dive into the first key ratio that we're going to take a look at, which is the debt to equity ratio. And the debt to equity ratio, you're going to find this information from your balance sheet for this ratio. And this is describing the percentage of assets that your company financed through debt versus the percentage of assets that were financed through owner's equity. So generally, when we're looking at this equation here, and when you're looking at a debt to equity ratio, and in this example, this is actually from Computer Solutions again, their debt to equity ratio is 1.9. Generally, a good debt to equity ratio, and this is very industry dependent, so this is why you probably want to find some financial ratio benchmarks from your industry, but typically a good debt to equity ratio is anything lower than a 1. And a ratio of 2 or higher is usually considered very, very risky. And that's because if your debt to equity ratio is lower than 1, then that means that your business is not over leveraged by debt. Okay. Now, if your debt to equity ratio is very, very low, then that could indicate to a lender that your business may be too safe. There's not enough risk that equates the rate of return. But overall, having a lower debt to equity ratio or something lower than 1 is going to be more healthy than having a super high debt to equity ratio, because a negative ratio or a super high one is a large indicator of risk and even bankruptcy. The next ratio is the current ratio. This is one of my favorites, and it's also one of the lender's favorites, because it is a great ratio to understand the liquidity of your business. And we already know, again, liquidity is how able your business is to cover its short-term financial obligations, or how easy it is for you to convert your assets to cash. So for the current ratio, it will take your current assets divided by current liabilities. And for Computer Solutions, the current ratio is 1.95. For your current ratio, a good current ratio typically is anywhere between 1.2 and 2, which means that the business has over 2 times more current assets than liabilities that it needs to cover its debt. So similarly to the debt to equity ratio, this ratio is describing how many current assets your business has versus those current debt or liability that it has to take care of. So if your current ratio is below 1, that means that your company, just simply put, does not have enough liquid assets to cover its short-term liabilities And if your ratio is exactly 1-to-1, that indicates that you have just enough current assets to cover those short-term liabilities. And so you're just able to cover all of your short-term obligations. So if you pull your current ratio for your company and it's hovering around that 1, that's an opportunity for you to try to address some of these liabilities or maybe invest in additional assets to strengthen that current ratio and the liquidity of your business. The quick ratio. The quick ratio is going to describe a percentage of assets that can quickly be converted to cash, but the difference between the current ratio and the quick ratio is that the quick ratio does not include inventory. A high quick ratio means that your business is typically financially secure in the short-term future. And so the quick ratio is more so used by those companies that do have inventory, because a lot of times that current ratio includes inventory. So the quick ratio is a better indicator of real liquidity because it takes out that inventory component, which isn't really seen sometimes as a current asset. Sometimes your inventory can be moved through really, really quickly, but sometimes inventory is not very liquid. And so because of that, the quick ratio can sometimes be an even more accurate indicator of liquidity than the current ratio, but very, very similar. If you have a low quick ratio, that means that your business has fewer liquid assets than liabilities, just like with the current one. And that also could mean that your business is having slow sales, or that you have too many bills, or you're not paying your bills on time, or that you may not be collecting from your customers on time as well, which can also lead to a loss in liquidity. A quick decrease or a very severe decrease in your quick ratio can indicate a very, very big problem for a product-based company. Now, your days receivable, this is also a very, very important one for all types of businesses, but especially consulting or service-based companies, because your accounts receivable is the account on your balance sheet. Your asset account is right under cash, so it's a current asset, and your accounts receivable is the account that all money that you are expected to receive in 30 days will sit in. So if you are expecting payment from a customer in 30 days, all of that money sits in accounts receivable until you receive it. So if it's past 30 days, if it's 60 days, that delays your accounts receivable. And what happens when your accounts receivable is delayed? That means that all of that money that's supposed to be converted to cash is not getting to cash. So that affects the liquidity of your company. So what happens when you have a new client that comes down the line? They're ready to sign on for a new project, and you don't have the cash that you need to go out and buy the supplies because you're still waiting to be paid, and that money is sitting in your accounts receivable. So accounts receivable is a very, very important account type to be aware of and manage. And your days receivable ratio is indicating the average number of days it takes your customers to pay. You want it to be 30 days or less, but this is also very industry dependent. A high days receivable ratio indicates that you are simply slow to collect. You're slow to collect money from your customers. A high accounts receivable ratio indicates that you are collecting payments very quickly. And when you're collecting payments quickly, that means that you're getting the money you need to go out and create new business or maintain the older business as well. Days payable is the opposite of that, the reverse. So days payable indicates the average number of days that you take to pay your supplier. A company with a high DPO takes longer to pay its bills, but that may also mean that it can retain those available funds for a longer time, which allows the company sometimes the opportunity to utilize those funds in a better way to maximize the benefits. However, a high DPO, a super high DPO can also be a red flag because it may be indicating, obviously, an inability for your company to pay its bills on time. So there is somewhat of a sweet spot with days payable and days receivable, and there's a lot of factors that determine what that sweet spot is. What industry are you in? What are the standards? what is the capacity of your target customer segments, and those type of things are going to be what help you consider what healthy ratios are for your company. So what does all of this mean? All of this information about financial ratios, about the different types of accounting systems, and about those financial statements can now be taken with you back into your business. And the first steps are for you to determine what financial information you have in order to try to create a general ledger and creating the structure that it's going to take for you to start creating these various financial statements. Today, we talked about a bunch of different topics, but we talked about and learned about the two different types of financial statements that are going to be the most important to your company, the profit and loss statement and the balance sheet. We learned a little bit about the two different accounting systems, cash and accrual accounting. And then we dived into these financial statements using the computer solutions case study and learned a little bit about financial ratios. I will now open it up to questions before we close out today. And I will also make sure for everyone's, I know that Eleanor, I believe, will share your email addresses with me so that I can send out a copy of the presentation. And if you are interested in setting up a counseling session to discuss your business really in any way, and if you're wanting to get some more assistance with analyzing your current financials, creating projections for the second half of the year or moving forward or anything related to your business development, I will be available. And thank you all so much. Okay, I have a question from Jessica here. How do accounts payable and receivable relate to the profit and loss? So accounts payable and receivable do not actually relate to the profit and loss statement. Those will be just on your, those are related more so to your balance sheet. And the reason why is, think of your profit and loss is just showing you what your company, it's just showing you the straight up sales. So it just shows you what your company made in terms of revenue and what your company spent. The accounts payable and accounts receivable are on the balance sheet because they are a part of indicating what your company owns, essentially, because that cash in the accounts receivable, well, the money that's in the accounts receivable eventually will be cash, which is an asset, something that your company owns. And so when you talk accounts payable and accounts receivable, they don't have a real impact on P&L. Those actually will just have an impact on the balance sheet. Great question, Jessica. Any other questions for us before I turn it back over to Eleanor? All righty, well, Eleanor, I will let you tell us. I don't know exactly what date QuickBooks is on, but I think that will be a great follow-up to this class, and I hope to see you all there. And like I said, I will make sure that I get out copies of the presentation to everyone as well. And I think, oh, okay, there she is. I see.
I am back. I was just popping a link into the chat for May. So May 5th is QuickBooks, and then June 2nd, we've got the value proposition canvas. And so I'm popping those links in the chat, and I'll also include these links when I email you the recording of the video. So thank you, Amina. Thank you, everyone, for showing up, and anyone who's watching the recording, thanks to you as well.